Hey, welcome back in. Listening to the Michael Hart Show on these Crawford Talk stations, and we're talking with Justin, talking with Russ about the infinite banking system, and in the process of talking about this and kind of simplifying it for someone like me, we've gone down the road of how we have changed our way of thinking when it comes to how to save.
Yeah.
So the IRS puts in a code, the 401k code, that we now know as being a 401k retirement plan. Based upon money markets and therefore either commodities or stocks. So they go up and down, which is why you get the statement that one time, you know, after your initial investment of, say, $50,000, one time it's worth $45,000, the next time it's worth $55,000. Right. So in the infinite banking system, you're the one that's in control of how fast it goes and how much money you put into it or how little money you put into it. The obvious question is going to be then, well, am I not already doing that by having a savings account at a bank?
Well, Russ, I want you to expand on this because we actually had a blog on our site, fireyourbankertoday.com, that I would encourage you and all the listeners out there to go check out. But I think the first question, going back to how we think, is we ask every client that we talk to, do you know the difference between savings and investing? And I think that is a very important question because over the last 30 years, I think those two have been blurred by our industry, partially. And there's a distinct difference. Savings is money that you can't afford to lose or you don't want to lose because it's earmarked for a specific event like retirement, like college, like buying a home, buying a car. That is savings. Investing is money that essentially you can afford to take risk with because the definition of risk is what you talked about. It's the possibility of loss.
Sure.
And any investment has that possibility. There's only one guarantee with an investment, and that is that you can lose all or a portion of your principal. That's written in black and white in the prospectus, the big book they give you when you buy any kind of mutual fund.
Right.
So there is a distinct difference between savings and investing. So the first step is understanding that, and the second step is deciding how much money that I'm putting aside monthly or annually do I want to save and how much do I want to invest. And I think to your point is once we identify that and we understand what we want to save, it then becomes where do we save it? And Russ, I think Russ did a great job of on the blog with that.
Real quick, before we get into, you know, the argument of, hey, I've got a savings account and doesn't that work? The other problem with the 401k, which is not necessarily a bad thing, is the fact that it's going to be a while before you're able to access it without any kind of penalty. And even when you get to a certain age, there may still be some sort of a penalty.
Well, there's a great thing, actually, I believe it's on our homepage. There's a video, and it goes into that concept that for the average person, they start working, let's just say 20 years old, and they work through 65. They start taking out money out of their 401k, and then at age 70, then they have some required minimum distributions that they have to take. Okay. And when you look at it over this, and let's just assume they live in another 20 years, over the life of that account, the average person's in a restricted phase 85% of the time because all the way up until 59 and a half, there's penalties if you take money out. After 70 and a half, there's penalties if you don't take a certain amount out.
Gotcha.
And so there's lots of regulation. And again, I think the point in which we're trying to talk about is how do we help people conveniently manage cash flow for the day-to-day and the future purchases, as Justin was saying, the needs that will come our way, and how to do it in a consistent but conservative long-term growth approach. And that's what Whole Life has always been. It's been one of those things that even the critics of Whole Life in the past, not done the way we're talking about, just putting in the bare minimum and letting it grow over a 20 or 30-year period of time, they actually produce pretty good results.
Okay, but then you get the argument, hey, I've got this account at ABC Bank or ABC Credit Union. It's a savings account. Why can't I just do it that way?
Why wouldn't I do it exactly the same way? So as Justin said, Will DeShazo in our office wrote a blog that was titled One Way in Which You Know How to Use Whole Life, 4 Ways in Which You Don't. And at the end of it, there's a video that I'd encourage you to go watch. It's 7 minutes long. You're going to have to listen to me for 7 more minutes. But it's going to be a video in which you could actually see a demonstration, a comparison between saving and borrowing money at a traditional bank. I just used a 3% return on a whatever account. You fill in the blank. It's earning 3% and buying a car. I gave that one example. And I compared it against saving and borrowing money from an insurance company. And what will be the difference? And one of the things that's interesting, Steve, is when everybody watches that video, they'll start to see, wait a second, there's some red numbers on this page when I'm looking at the saving at the traditional bank. Those red numbers are taxes. Now, did you know, Steve, that if you were to earn interest on your traditional savings accounts, because right now most people aren't, so it's not a real issue, but hopefully interest rates will rise because that will mean our economy is actually moving in a direction of back to what normality should be. If you actually earn interest, you pay taxes.
Yes.
And paying taxes is a good thing, right? That means we earn something. But unfortunately, those red numbers prevent us from compounding on our money. And Justin has one of the greatest talks on how compounding works, and I'll let him say this in a second. But when we go through that video, people will see those red numbers and how it impacts the bottom line. And when we show the insurance account, we show using the whole life policy, then we see how compounding without those red numbers, how it starts to add zeros to the bottom line.